$1.12. That's your first dividend payment. Not $1,000, not $100, not even $10. $1.12, deposited on a Tuesday. While you were at work, while you were doing something completely unrelated to money. You didn't earn it, you didn't trade for it, you didn't show up for it. It just arrived. And something about that $1.12, that completely insignificant, laughably small $1.12, rearranges something inside you that no salary ever did. Because a salary pays you for your time, and your time runs out. But this paid you for doing nothing, and nothing is renewable. Level 1, the first dollar. Age, any. Investment, $0 to $5,000. You buy your first share on a Wednesday afternoon, not confidently, not with a plan, with $500 and a feeling somewhere between curiosity and low-grade financial anxiety. The stock is a Dividend ETF, total market, expense ratio 0.06%. You read about it on a forum at 11 p.m. and decided this was the one. You are not wrong. You just don't know why you're right yet. The first dividend hits 47 days later. $1.12. Paid quarterly. Deposited without ceremony into your brokerage account. You screenshot it. You send it to nobody because nobody would understand why a grown adult is this excited about $1.12. But you understand. Because $1.12 didn't come from your labor. It came from your decision. That distinction is everything. The first rule of dividend investing. The first dollar is not about the money. It is about the proof. Proof that money can work while you don't. Proof that the machine exists. Proof that you are now, however small, on the other side of the transaction. You reinvest it, all $1.12, back into the same fund. You don't need $1.12. You need the share it buys, and the dividend that share will one day pay. This is called DRIP, Dividend Reinvestment Plan. Automatic, invisible, relentless. The snowball has started rolling. It is the size of a marble. You cannot feel it move, but it is moving. Level 2, the consistency. Investment, $5,000 to $25,000. You automate $400 a month, not because $400 is comfortable, because $400 is the number you ran the math on, and it was the highest number that didn't break anything else. You set it to transfer on payday, before you see it, before your hands can redirect it somewhere more immediately satisfying. Month 3, month 7, month 11. The balance grows, slowly, then slightly less slowly. Your annual dividend income crosses $200, then $400. You do the math one evening and realize at current trajectory you'll cross $1,000 in annual dividends by month 28. Month 28 feels far away. You keep going anyway. This is the hardest level. Not because it requires skill, because it requires faith in a process that shows results too slowly for the human brain to feel motivated by. According to Vanguard's research, investors who check their portfolio daily are significantly more likely to sell during downturns than those who check monthly. The math doesn't care about your attention. It only cares about your consistency. The market drops 14% in October. Your portfolio loses $1,100 on paper in 3 weeks. You don't sell. Not because you're fearless, because you did the math on what selling means. Selling means locking in the loss. Selling means missing the recovery. Selling means the 14% drop becomes permanent. Staying means it's temporary. You stay. The second rule, the market will test your commitment before it rewards it. Every single time, without exception. The dividend keeps paying, even during the drop, even when the share price falls. The income stream runs independent of the fear. That's the first time you feel it. The separation between price and income. Between what the market says your shares are worth and what your shares actually pay you. Price fluctuates, income compounds. You start to understand which one matters more. Level 3, the acceleration. Investment, $25,000 to $75,000. Something changes at $25,000, not dramatically, mathematically. At $25,000 invested in a fund yielding 3.5% annually, your dividends produce $875 a year, $72 a month, before reinvestment. But you are reinvesting. Everything, every quarter, every $72, every $1.12 before it. And the reinvested dividends are now buying shares, and those shares are paying dividends, and those dividends are buying more shares. The snowball is no longer a marble. You can feel it now. Your net worth crosses $40,000. Your annual dividend income is $1,400. That's $116 a month, paid to you every month, whether you work or not, whether the economy cooperates or not, whether your boss is happy with you or not. $116 a month is not financial freedom, but $116 a month is your phone bill, covered by money that makes money. You start thinking differently about expenses, not as costs, as dividend targets. How much invested capital does it take to cover this expense forever? Your $60 monthly streaming subscriptions? That's $1,714 invested at 3.5% yield. One time, forever covered. Your $200 monthly grocery bill? $5,714 invested, forever. Your $800 monthly rent contribution? $22,857 invested. You start seeing every expense as a portfolio target, a specific number you need to reach to make that cost disappear from your budget permanently. This is the reframe that changes everything. You stop trying to earn more. You start trying to own more. The third rule. At this level, dividends stop being income and start being a language. Every payment tells you exactly how close you are, not to retirement, to each individual expense, one by one, until there are none left. Level 4. The real number. Investment, $75,000 to $150,000. You are 34 years old. Your portfolio is $91,000. You do the math one Sunday and something shifts permanently. At your current contribution rate of $600 a month, you increased it 8 months ago, and a 3.5% yield with full reinvestment, your portfolio reaches $200,000 in 6 years. At $200,000, your annual dividends are $7,000. That's $583 a month, passively, forever. You run the number again, then again. The compound interest calculator doesn't lie. The math is real, and it is patient, and it has been running quietly in the background since the day you bought that first share with $500 and mild anxiety on a Wednesday afternoon. Your dividend income this year is $3,185. You paid your car insurance with dividends. You paid your internet bill with dividends. You took a 4-day trip and the dividends covered the hotel. Nobody at the hotel knew. Nobody on the trip knew. Nobody knows. You have learned that talking about money at this level makes people strange. Not because they don't care, because they can't feel the math yet. They see the number, they don't feel what it took to build it, and they don't feel what it will eventually replace. You stop explaining, you keep building. The fourth rule. Somewhere between $75,000 and $150,000, dividend investing stops being a financial strategy and becomes an identity. You no longer have a portfolio, you have a machine, and the machine has preferences. It wants to be fed. It resists being touched. It rewards patience with the specific, compounding loyalty that no employer ever offered you. Level 5. The crossing. Investment, $150,000 to $300,000. $1,000 a month. It arrives in pieces. Quarterly distributions from 3 different funds, monthly payments from 2 REITs, a preferred stock that pays like clockwork on the 15th. But when you add it up at the end of the month, it crosses $1,000 for the first time. You are 38. You have been doing this for 11 years. You sit with $1,000 for a long time. Not because $1,000 changes your life. Your salary is $87,000. $1,000 is significant, but not transformative. Not yet. But $1,000 a month is $12,000 a year. And $12,000 a year is what a lot of people live on. And that means somewhere on this planet, your portfolio generates enough income to sustain a human life. Not your life, but a life. That thought lands differently than you expect. You start diversifying more intentionally, not just total market ETFs, dividend growth stocks, companies that have increased their dividend every year for 10, 20, 25 consecutive years. The dividend aristocrats, companies like Johnson & Johnson, Coca-Cola, Procter & Gamble. Businesses so stable that they raised their dividend through 2008, through COVID, through every crisis the last century threw at them. You add REITs for real estate exposure without owning property. You add international dividend funds for geographic diversification. Your yield on cost, the yield on your original investment, not the current price, is 4.8%. Because the dividends grew while your cost basis stayed fixed. This is the hidden advantage nobody talks about at the beginning. The yield on cost that compounds silently for decades until the income stream bears no relationship to what you originally paid. The fifth rule. The crossing from 4 figures to 5 figures in annual dividend income is not a financial event. It is a psychological one. The moment you realize the income is no longer supplementary, it is structural, a permanent part of your financial architecture that exists independent of your employment, your health, your geography, your age. Level 6. The machine. Investment, $300,000 to $700,000. You stop counting contributions, not because they stopped, because the dividends themselves are now contributing. At $340,000 invested with a blended yield of 3.8%, your quarterly dividends are approximately $3,230. You reinvest $2,000 of it. The other $1,230 you use. The portfolio is buying itself. This is the inflection point that the books describe, but that you have to feel in your own account to truly understand. The machine is no longer dependent on your paycheck to grow. It is feeding itself. Your contributions accelerate it, but they are no longer the engine. The engine is the income. Your dividend income this year is $19,400. You look at that number on a Tuesday afternoon in January and feel something that you have no clean word for. Not pride, not relief. Architecture. The feeling that something permanent has been built. Something that doesn't require your presence to function. Something that will be here after the job changes, after the market shifts, after the decade turns. You have held positions through 2 market corrections at this level. You did not sell. The dividends kept arriving, reduced slightly in one correction, stable in the other. The income stream proved more durable than the prices. Your portfolio is now $487,000. Annual dividends, $21,600. Monthly income, $1,800. You have not told your family the exact number. You have told your spouse. Nobody else. The 6th rule. At $300,000, the portfolio stops being a savings account and becomes infrastructure. Infrastructure that generates, compounds, and persists. The question is no longer how much you have. The question is what the machine produces while you sleep. Level 7. The freedom number. Investment. $700,000 to $1,500,000. $5,000 a month. It arrives without you doing anything. You check the account on the 3rd of the month, the day the last distribution clears, and the number is there. $5,012. This month. From money that makes money that makes money. You are 47. You have been doing this for 20 years. Your portfolio is $1,100,000. Blended yield of 4.1%. Dividend income, $45,100 annually. Monthly average, $3,758. But the monthly distributions are uneven, some months higher, some lower, and this month cleared $5,012. You have a salary, you don't need it the way you used to. The salary funds lifestyle, the dividends fund freedom. The distinction is the whole thing. You start thinking about the 4% rule differently. Most people use it for retirement. Withdraw 4% annually, the portfolio lasts forever in most historical scenarios. At $1,100,000, that's $44,000 a year. But you're not withdrawing. You're living off the income while the principal grows, which means the machine is getting larger while you use it, which means the income will be higher next year than this year, and higher the year after. Compounding doesn't stop when you retire. It stops when you sell. You are not selling. The 7th rule. The freedom number is not a net worth target. It is the month your dividend income exceeds your essential expenses. For you, that month arrived at $3,200 in monthly dividends against $2,900 in essential monthly costs. The number that matters is not what you have, it is what it pays. Level 8. $10,000 a month. Investment. $2,500,000 plus $10,000 arrives in your brokerage account on a Thursday. Not all at once. Distributions from 14 different positions across 6 fund categories accumulated over the month, clearing and settling on different dates, adding up to $10,340 by the 28th. You are 54. You have not worked a job you didn't choose in 7 years. Your portfolio is $2,800,000. Blended yield of 4.3%. Annual income, $120,400. Monthly average, $10,033. You remember the $1.12. You remember the Wednesday afternoon, the $500, the forum at 11 p.m., the mild anxiety that felt like a beginning because it was. You remember the 14% drop in October that tested your commitment and the dividend that kept arriving anyway. You remember the Sunday math session at 34 that showed you $200,000 in 6 years and felt like a fantasy and turned out to be a projection. You think about the investor who sold in October, the one who couldn't hold the position through the 14% drop, the one who locked in the loss and missed the recovery and missed the decade of dividends and reinvestment that followed. The difference between that investor and you is not intelligence. It is not income. It is not even discipline in the way people mean when they say discipline. It is the understanding, early, felt in the body rather than known in the mind, that the income is the thing, not the price, the income. Price tells you what someone would pay for your shares today. Income tells you what your shares pay you every single month, regardless of what anyone would pay. You spent 32 years building an income stream, not a portfolio, an income stream. The portfolio is just the container. The final rule: $10,000 a month in dividends is not a number. It is a proof. Proof that the machine works. Proof that time is the most powerful investment variable. Proof that the $1.12 was never about the money. It was about the decision to become the kind of person who lets money work while they live. The $1.12 always starts there. It always will. You are sitting with someone tonight. They just opened a brokerage account. Their first deposit? $500. They're nervous about it in the way that means they take it seriously. They ask if it's worth it. You don't answer right away. You think about 32 years of Tuesdays, of quarterly deposits, of market drops you sat through, of math sessions on Sunday evenings that showed you numbers too large to believe and turned out to be conservative. Then you tell them the truth. The first dollar is not about the dollar. It is about the proof. Start there. The machine is open. It always is.